Good afternoon and welcome to another edition of Money Matters. My name is Dan White. I am the founder and president of Dan White & Associates, a retirement and financial planning firm with 3 locations. Our main headquarters is in Glen Mills, Pennsylvania. We have a second office down in Middletown, Delaware, and we just this year opened a third office down in Lewis, Delaware, down the beaches. And we're happy to be back after our summer break here on Money Matters. I'm going to be joined today by Eric Parnell from the Great Valley Advisors Group. Welcome to the show, Eric.
Dan, it's great to be back with you today.
Yeah, we've done this once or twice before, and it's kind of an interesting time in our business. We had a debate last night, and there's a couple major things that are going to happen here in the near future. The Federal Reserve, for example, meets next week, and all we keep hearing is Jerome Powell was at Jackson Hole, and he said, I think the time has come to reverse direction or change course. With the Fed starting to at least consider lowering interest rates, they've been paused for over a year. Can you speak as to how you think this is going to affect the markets?
Well, it's at long last, right? I think all the way back to 2022 when the market was anticipating rate cuts from the Fed, and it's really had to wait a long time, but it seems as though the market's finally going to get those interest rate cuts that it's anticipated. And, from a sustainability of gains standpoint, the fact that the market's going to get additional liquidity from the Federal Reserve in an environment where economic growth remains strong, inflationary pressures continue to come down, even if today's CPI report was a little bit stronger than expected. That's the type of fuel that helps support higher stock prices, even if valuations might be a little bit elevated. But the one thing I wonder about is that, we have a market that up until recently was pricing in as many as 9 quarter-point Fed rate cuts between now and this time next year, which is, that's a pretty aggressive expectation that the market has. So one wonders if there might not be a little bit of disappointment that investors could feel if we don't get that many rate cuts over the next year.
Yeah, I know coming in this year, they were pricing at least 6 in for 2024. And, it's kind of a classic thing, though. Everybody thinks lower interest rates are the panacea for everything. The market's just going to shoot up. And, for years, it was bad news is good news. There's bad news. They're laying off people. That's good news because the Fed's going to cut rates. I think we're almost approaching the point, correct me if you think I'm wrong, where bad news might actually be bad news.
Yeah, no, that's one of the things really since we had the inflationary outbreak in 2022, the perspective has kind of shifted a bit, where we're now in an environment where the market seems to struggle to get comfortable with the idea that good news, strong economic growth, lower inflation, corporate earnings growth that's rising is actually good news. But to your point, if good news is going to be good news, we could also be entering into an environment where, bad news is actually bad news. And One of the keys, I think, to watch in that regard is the inflation data, because if the Fed starts cutting interest rates and we see a renewed rise in headline inflation or core inflation, that could be a real problem for investors if that starts to manifest itself.
Yeah, that's been Jerry Powell's biggest concern is they didn't want to cut too soon. They didn't want to, like the 70s where it came roaring back.
Yeah.
He didn't want to do that. And I guess the dual mandate of the Fed is not only inflation, but also employment. And we have seen employment tick up. It was 3.5 for a couple months last summer. And the SOM rule says, hey, when we get a half a point above the average, so when we get over 4%, we're in a recession. Now they've kind of walked that back a little bit, but we are seeing layoffs. We're seeing companies, Home Depot came in and said same-store sales are going to be down. Technology's laying off a lot of people. I mean, maybe you can speak a little bit where, and that's again another reason to cut rates. Bad news is finally bad news. Unemployment's going up.
Yeah, and that's part of the conundrum, because you're right. We have seen the unemployment rate tick up. We're starting to see layoffs. And, at the same time, it's like you said, the 1970s, tightening monetary policy in order to combat inflation is like taking a course of antibiotics. If you quit the antibiotics too soon before you've totally eradicated the problem, the situation can come back and be worse. And we saw that 3 times in the 1970s. So the question becomes, if they start cutting interest rates too soon this time around, there are inflationary pressures underneath the surface. You think about service inflation, housing costs. The inflation rate there is still around 5% underneath the surface. And if that starts to percolate, then that could be a problem.
And I got to give Jerry Powell a little bit of credit, because after the markets kind of took a nosedive in early August, people were calling for like an emergency meeting and a 75 basis point cut. And he kept his cool and said, just relax. Yeah. And let's wait till the next meeting. So that actually worked out. But
yeah,
let's pivot a little bit to the second elephant in the room, and that's in about 55 days we have an election. Absolutely. And I don't think you could have two more opposite points of view or candidates than we have running this year. But with the upcoming election, regardless of who wins, how do you think taxes are going to be affected for Americans?
Well, I think the biggest thing to watch is not only the outcome of the presidential election, but also the outcome of the U.S. Senate and the U.S. House of Representatives, and who controls those two legislative bodies within the Congress. Because if one party wins the presidency and another party wins the Senate or the House, there's probably not a whole lot that's going to get done from a tax perspective or from a policy perspective, as long as there's that gridlock in Washington. Because certainly in recent years, we have really seen the inability of both sides to work together. So that's one of the things to really watch, is that, do we see a clean sweep like we saw in 2016 when the Republicans won the White House, the Senate, and the House? Or is it a situation where we have split government, where there's one party in the presidency and split control of the Congress? So that'll really be a key to watch. But if we do get a clean sweep, then we could really see some changes on the tax front.
Yeah, clean sweep, all bets are off. But, gridlock, that's kind of what we're, if you have a split, then you're going to have gridlock. But the monkey in the room is the Trump tax cuts, the tax jobs cuts. That expires the end of next year. So even if you have gridlock and they don't get anything done, tax rates are going to go up.
Yeah, no, absolutely. And I think that's one key to watch, is that, do either side have the appetite to allow those current tax cuts to expire? And I think another thing to watch too is that if there is likely to be a sweep, it's likely to be on the Republican side. And that has to do with the way that the Senate map falls for this election cycle. Mm-hmm. And if we do get a sweep on the Republican side, there's one key difference in 2024 versus what we saw in 2016. In 2016, when we had a Republican sweep, the markets quickly embraced this idea of corporate tax cuts. And we saw a rally in the market for the next year after we got those tax cuts. But in 2024, if the idea comes around that we're going to see more tax cuts coming with a Republican sweep, which is a low probability event, but still something that we could see, the market might not react with the same level of enthusiasm this time around, because the lingering inflation pressures, because the market might see that and say, wow, tax cuts with inflation not fully down yet, we could see an inflation spike this time around, and the markets might not respond the same way as they did 8 years ago.
Yeah, I mean, I hate to say it, but I think whoever inherits it when they get in November, I don't think it looks really great for the markets. I mean, valuations are at all-time highs. You still got that inflation, out there a little bit, and the taxes. I mean, I think if Trump wins, I think he extends the tax cuts from 2016. I think if Harris wins, obviously they're going to try to raise taxes. So it's going to be kind of dicey.
Yeah, it'll be interesting to see.
Yeah, inflation has also been the huge challenge. What strategies that you work with what strategies do you help retirees face? How do you help them face that challenge and ensure, their nest egg lasts as long as they do?
Yeah, no, absolutely. Here at Great Valley Advisor Group, we basically manage investment portfolios for advisors serving clients. We're a hybrid RIA, so we serve advisors, registered investment advisors serving clients. And inflation protection is a big part of what we do in terms of the asset allocation process, being prepared for all different types of market environments that we could face in the future. And, that inflation management includes the types of equities or the types of stocks that you put into a stock portfolio, because they can be an inflation hedge, as well as how you manage duration on the bond side, or basically how long investors are waiting for the bonds that you own to mature. Because in inflationary environments, there's definitely a benefit to shortening duration. Because why not get paid a higher interest rate from the Federal Reserve while they're fighting inflation without taking on that duration risk or that bond price risk?
Yeah, that's a good point. I think no matter what happens, I think the next 3 to 6 months we're in for a little bit of a bumpy ride. So you better buckle up, But
Absolutely.
we do have a question though from one of our callers, Frank Gilbert from Philadelphia. Eric wants to know, what is the safest investment with the highest return?
No, that's a great question, Frank. And basically, I'm going to give you three answers to this question that all kind of roll up into one. The first, if you're thinking about stocks, the safest investments with the highest return are your high quality, low volatility defensive stocks that have pricing power. So think about your healthcare companies, like your pharmaceutical companies, or your consumer staples companies, like food or household products, or even some of your utilities. Those that have stock-like return characteristics, but have that ability to hold their value when we get into bear markets, like we saw in 2022, or during the financial crisis, or even the bursting of the tech bubble. A second investment to consider is high-yield corporate bonds. One of the things, it's got bonds in its name, but high yield bonds trade like stocks, but with less volatility than stocks. And a third is the good old fashioned treasury bond. You own the treasury bond, you might see volatility along the way in the value of it, but the one thing that backed by the full faith and credit of the US government, is you're going to get your money back at maturity. But the last element, the safest thing, is to put all three of those components together into a single portfolio, because then you get more consistent returns with a lot less price volatility.
Well, thanks for that. And if you have a question for Money Matters, here's how you can send in your questions to us.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our hosts and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
And today we are thankful we have Chad Zoretic, a partner with Armanino LLP, a top 20 tax and consulting firm with offices all around the country. We have Chad on the show today. Welcome to the show, Chad.
Hey, thanks, Dan. Great to be here.
Yeah, and before the show, I got to chat with you a little bit about what your company does, and you kind of make deals. I mean, you buy and sell businesses, and that's kind of an interesting thing. We've all kind of watched that show Billions, on Showtime.
Well, we don't take that much risk. We're not the ones doing the buying and the selling. We're advising.
Just kind of tell us, with the economic environment that Eric and I just talked about, what is the current pulse on kind of getting a deal done in the middle market landscape today?
It's tough. I mean, the interest rates have not lowered like folks were hoping. I mean, it looks like that's on the way in the very near future. So buyers and sellers have had to get a little more creative with covering the valuation gap. And also with the cost of debt being higher, it seems like there's even more homework and diligence being done prior to to closing a deal. And so it's kind of drawn out and lengthened the deal cycle in terms of start to finish from to a close.
Chad, it's great to see you today, and I'm looking forward to discussing the topic with you. You think about a private equity deal, and you have different firms, different key players. What are the key traits of getting a successful deal done?
From a seller's perspective, preparation, and that's just probably true in almost all walks of life. But the better prepared you are, it raises the confidence index of getting the deal done. And by preparation, I don't just mean from a financial diligence perspective. I'm talking about, are you properly prepared to address all the questions that are going to come in from the whole cast of characters? There are a lot of stakeholders in the process, so you have to be well prepared to answer and address financial questions, tax questions, legal questions, commercial questions, to underwriters, investors, accountants, lawyers, etc.
Yeah, it's kind of interesting though. When you mention this, I'm working with with some clients right now. They're trying to sell a car wash, and they thought they had a done deal, and then they, the soil testing, and they're on some type of site where they have to go do phase 2, and it might blow the whole deal up. But just briefly describe, in the work that you do, Chad, who are some of the cast of characters involved in some of the deals that you advise on?
So typically when I'm advising on an exit, and I work primarily with lower to middle market businesses. So we're talking about enterprise values anywhere from 25 million to 250 million, just for some reference and frame of scope. But typically I'm on the financial end, and we basically get the financials exit ready, if you will. So setting up the financials so that it makes it easier for potential investors to go through and learn about the cash cycle of the company, learn about the revenue growth rate and the different growth rates, and learn quickly about the cost structure of the company and key profit drivers. Additionally, on the balance sheet side, learning about the cash conversion cycle and the quality of the assets and measurements of liabilities. So we take care of that end of it also, but then also working in conjunction with the investment bankers who are doing the matchmaking and helping explain the story of the company, as well as finding suitable investors for the company, and also collaborating with the lawyers. Because and the lawyers may come in a little bit later, but what is agreed to in concept needs to be translated into the actual purchase and sale agreement so that legally it matches up with what was agreed to in concept.
You mentioned the matchmaking aspect of it, Chad. And who are the buyers, and where does the capital come from in order to fund these private equity deals?
Well, there's really two general buckets of buyers. You have the private equity and financial buyers that often will have already money in a platform company or a portfolio company, and they may be adding on to that platform. Or you have straight out, corporate or strategic large corporations making the purchase that really generally know that industry well and can operate it well. And each one is a little bit different in terms of what they're looking for in the company that they're looking to acquire. And the diligence process can differ between the parties. So meaning some corporate buyers, if they are great operators in that industry already and really know the ins and outs of it, may be less concerned with some of the items because they're going to just fully absorb the company anyway and do it their ways. Versus a private equity group, if they're going to make a platform investment, they want to be extremely sure, number one, of the management team in place if they're going to continue running it as a platform, and number two, have any of the holes identified that need to be filled up quickly, and it could impact the enterprise valuation as well.
So you just said something pretty interesting, Chad. Like a platform company, if they're buying into a space where they don't have a whole lot of experience, is it kind of a usual practice that they might include like a 5-year, hey, the management team has to stay on for 3 to 5 years, something along those lines?
Yeah, and typically they'll actually have the management team participate as well, like roll in some equity into the future success of the company, and or earn out that's also can also be added to it. If it's a private equity firm that is investing in an industry that is kind of new territory for them, they are extremely interested in the strength of the operating team of the platform, unless unless they have already selected and have a team of operators that already, identified that can be added to the team as well outside of the transaction.
So, Chad, say you have a business and you'd like to sell. What are the things that you should be doing to prepare yourself to sell, and when do you need to start the process?
So, earlier the better, and a lot of preparation. And by earlier, I actually that early process starts years in advance, like to give you the best option. Meaning, it could start as like several years in advance, just with how you're set up tax wise from a corporate entity perspective. Do you have the right election, and or you set up the most optimal fashion for exiting, 5, 8, 10 years from now? In terms of getting ready to think about market, I say two things really. One is the exercise of getting your financials ready is actually a very good diagnostic activity, and it can help you run your company. So maybe you do it with no transaction necessarily in sight, but you become transaction ready and find some things out about your business that you would want to fix. Similar to maybe having your house inspected to, replace a few shingles or a crack in the foundation. You might as well do it. Secondly, you definitely want to do it if you are planning to go to market. I would say at bare minimum 6 months in advance, because it takes time to get the numbers lined up. It takes time to cut off loose threads, fix things, and also get everybody on board. I mean, that gives you a little bit of leeway, but not much to do any major remediation. So if you get started earlier than 6 months, you have a little bit more time to actually fix things operationally and have track record to support the notion that you've fixed it, if it is even uncovered during diligence.
It kind of sounds almost like a real estate transaction, like you're staging the house, getting it ready for sale. Do you typically work with, for lack of a better term, the buyer, the seller, or who do you represent?
So our practice, we actually have a pretty even mix of what I call buy side, which is working for the buyer, and sell side, which is working for the seller. It's actually almost 50-50. It's really the same set of procedures from a financial due diligence perspective. But on the sell side, when we're helping a company exit or get ready for exit, it is meant to expose everything, right? And not necessarily for staging and to put some makeup on it. It is really to, hey, diagnostically, we need to address this, or you have to address it, or have a plan to address it so that it can be thoughtfully responded to when it comes up in due diligence from the buyer side. Because I can assure you, it will likely come up 99.9%. The buyers are very diligent in doing their analysis.
Chad, one of the things that you mentioned along the way is, diligence and financial diligence. What is financial due diligence, and how does that differ from an audit? What are the details behind that?
Yeah, so from financial due diligence, you may hear a phrase called quality of earnings. A lot of time that is kind of the lingo used with financial due diligence. And what that is basically getting your financials, your income statement, to present it on a recast basis, meaning an adjusted basis, and stripping out items like non-recurring items, or if there was like a mid-year acquisition and you wanted to present the business showing a full year, like what it would have been like for all 12 months of having that add-on acquisition in there. That is called pro forma financial statements from both an income statement and a balance sheet perspective. The quality of earnings is the exercise around that, identifying the adjustments and recasting all the financials. It also does get into identifying and doing analytics on the profit drivers of the company. So not only do you know percentage-wise how much revenue and gross profit and earnings have grown, but what were the drivers of that? Why did it grow? Why did margin expand or compress? And have some of those key items answered so that it can be factored into the future forecasting of the business as well. An audit is, there's far more testing done with an audit. It is also, I think, a behavioral element to it where it implements a discipline, a financial reporting discipline to a company. And it is also very valuable because it kind of is the guide map to proper accounting, if you will. So I strongly encourage companies, if they're not audited and then they go through an audit, I think it's a really good thing. And don't view it as just, oh, I have to get an audit for debt compliance, debt covenant compliance purposes. Make good use of it.
It's interesting, Chad, having worked with a lot of insurance companies over the years, I've seen this from both sides. In the 90s, a company I wrote business for, Provident Mutual, was acquired by Nationwide. I don't know how the deal was set up, but they bought the entire distribution system, and then 3/4 of the distribution system left the company after the sale went through. And then I've seen a field marketing organization that was purchased by another company. And as you said, they actually gave some of the players ownership in the new company just to keep them on. So I guess there's two different ways to do it. But what can you speak a little bit about that? About what you have a deal all lined up and then it falls through? What would make it fall through?
Fatigue. A lot of times it's fatigue, but generally a lack of trust. Something in the process happens or something's uncovered, and there just is a lack of trust that starts happening. And if the trust is breached so much so that you can't quickly repair it, that's why a lot of deals fall apart. Sometimes last minute, wheeling and dealing and trading can happen, but I think generally it's a broken trust that drives a lot of deals to not complete.
Do you see a lot of situations where they do provide ownership to the sellers?
Yes, yeah, and it's quite common in private equity, especially in a platform situation where the private equity is acquiring that company to use as a platform investment.
That's great stuff, Chad. We really appreciate you coming on the show today. I know I learned a lot about the mergers and acquisition space. I think it's happening more and more, and it was great having you on the show to really fill us in on some of these areas. Great, thanks a lot, guys. I really enjoyed our conversation. Yeah, and our next guest, if you tune in next week on Money Matters, is going to be Katie Wenger, a vice president at Lauer Cat Consulting. She's going to be on the show next week. So you want to stay tuned for that. And for anybody else out there, we hope you enjoyed this edition of Money Matters and have a great week.